Welcome to another Southbank Investment Daily Bulletin. Now, I thought that on this week I would concentrate on bond yields, something that I don't think most people have just a real comprehension of. But one thing we can see clearly is that the rate right now is higher than at any point it's been in the last decade. But the higher the yield goes, it means that borrowing costs are rising. So from the perspective of a borrower, they have to pay more, and therefore, in order for someone to lend to them at that level, well, one would think that on the one hand, if yields are high and the borrowing cost is high, it means there must be more risk in the market. So if I'm lending, then I'm demanding a higher return in order to give whoever wants to borrow money my money. But when you get yields up to 4.5% or testing the 5% level, well, then you can actually make returns as a bond investor. Back in 2020, or indeed in 2019, yields were a lot lower. So in order to make money as a bond investor, what you were really relying on was momentum. Now let's flip it around. These are yields. Now let's look at prices. Now the easy way to look at prices is with the futures chart. But because of coupon changes, you do tend to get very choppy action within the futures. So the futures prices have been declining very steadily. Now you can see here that all the way from 2008 onwards, we had obviously this choppy action here is when there's a contract change, but we can see very clearly that prices in 2008 rose quite steadily. They were more or less around par, just a little bit more than 100. When you buy a bond, you're buying it at par, or that's not strictly true. In fact, what you're doing is you're guaranteeing that you'll be repaid at par at the maturity of the bond. And when yields are, when the return on the bond is a little bit less than the coupon, well, then the price goes up. So the price went from a little bit over par to 140 by 2020. That's an awfully big premium for something that will be maturing at 100. And it implies that growth would be very low, that there wouldn't be any inflation. Now, of course, since then, we've seen that futures prices have, in fact, declined exceptionally quickly and are now trading well below parity. Now, those bonds are still going to mature at 100, which means that today you get to buy them at a discount. Well, when something is on sale, then demand for it increases. So this is what I wanted to try and highlight for you, because when I sit on investment committees, when I talk to family offices, this is the topic of conversation that comes up when it comes to the decision on whether to invest in the stock market. Well, it's about what we can earn on a guaranteed return from a bond. So let's not concentrate on the 10-year. Instead, let's just look at the 2-year, because right now in the 2-year gilt, you can get 5%, and a 5% guaranteed return versus volatility in the stock market. Well, then that's obviously something that is a big differentiator, because I might be able to make more than 5% in the stock market, but how much risk do I have to take on? And if I can lock my cash up for the next 2 years and earn a guaranteed 5%, I think a lot of people are going to be quite happy. Now, when the 2-year yield was less than 0%, you were making nothing on your bonds. In fact, you had to pay the government to take your money for 2 years. But now, of course, at the time, what that forced people to do was to speculate. You don't have quite the same pressure to speculate now. So when we look at the performance of global markets over the course of this year alone, well, we can see, for example, that year to date, the FTSE 100 is actually in negative territory. So the right decision has been to own bonds. then when we look at it on a currency adjusted basis, well then, in US dollar terms, a foreign investor is making almost 3% in the stock market. Now, of course, there are plenty of other markets that have done substantially better, and then there are plenty that haven't been doing very well at all, particularly those in China. But the big picture here is the risk premium. What is the premium that investors demand for earning more money in the stock market? Now, this is a big question because when we think about the spectacular advances that we've seen in the artificial intelligence sector, NVIDIA, for example, has gone from about $100 and change last October to test $500 last week. It's a phenomenally large advance. So if you were investing in high technology shares over the last 6 months, well, then you were richly rewarded. And that rationale for owning bonds relative to making several 100% doesn't really make a lot of sense. But stock markets generally haven't been doing that. Now, let's also then look at this, that if we think about high yield bonds, which would be riskier bonds, well, what you're now getting is about 4.37% over the treasury rate. So these are US bonds. But because US treasuries are in excess of 4%, what it means is that in those triple or in high yield bonds, which would be triple B and less, then triple B minus, I should say, and less, then what you're actually getting is nearly 9% of a guaranteed yield. Now, this is not the same kind of wides that we've seen in the past. In crises over the course of the last nearly 20 years now, there have been several spikes in the high yield bond spread. Lots of those companies used the very tight spreads of the pandemic to refinance. So there isn't any pressure on many of these companies to refinance their debt. They seldom pay it back. They mostly refinance, but they don't have to do it anytime soon. So that is offering a very competitive yield in the bond market relative to the returns that are being provided in the wider stock market. Now, my main point in highlighting this about bonds is simple, that when you have high valuations and you have very low bond yields, well, investors don't have much of a choice. They just have to buy the stocks because they can't get a return in their bonds. But when bond prices have fallen and yields have risen, now the stock market has more competition. And this is part of the reason why stocks have been so volatile and why it's really only a very small number of shares have been doing very well, whereas the rest of the market hasn't been doing much of anything. It's because stocks now have competition. Well, then, of course, the next question is, what's going to be required for stocks to then become more competitive? Well, one way would be for valuations to decrease, and usually the way to do that would be with lower prices. So that's one way. The second alternative would be for bond yields to contract. So you wouldn't be getting the same guaranteed yield. You might get some price appreciation from owning a bond, but you're not going to get any new investor, at least, wouldn't be able to capture the same yield. And that would imply that deflationary forces are coming up. But of course, deflation wouldn't be particularly great news for many companies either. So in order to correct this mismatch, then we will probably need to see slower economic growth overall, which is in fact what central banks want. They want slower economic growth. They want somewhat higher unemployment so that they can get the inflation problems under control and back into manageable bands. And they're probably going to continue tightening policy until they reach their objective. I think with that, I'll leave you for today, and I'll wish all the best to all of you.